All right. Good evening, everyone. Happy Tuesday. Thank you for being here with us this evening. We're going to get started here. I would encourage anyone, if you have any questions during the presentation, there is an area where you can answer your questions. We're going to stop a little bit towards the end to answer questions, so please feel free. If there's anything that you're interested in, jot it down there and we'll make sure to address it for you. So welcome again, everybody. This evening, we're going to be talking about tax savings. It is that time of the year. I was just talking to Rob. I just filed my extension. It seems like it's been such a busy year this year, and you know, all the advice and help we can get is certainly appreciated. So Rob, thank you so much for being here tonight. Our clients certainly appreciate it.
Of course.
All right, guys, a little bit about me. Hello, my name is Tyler. It's nice to meet you. I'm a real estate advisor here at Marshall Reddick. And so my job is to talk to our clients about their goals when it comes to real estate, understand their timelines, their capital stacks, what they're trying to accomplish, and then ultimately help them, decipher what kind of real estate investing vehicles would help them accomplish those goals. We have a few different vehicles here at Marshall Reddick, and we'll dive into those, and they all behave differently, they return differently, they act differently. There's no right or wrong answer. It really comes down to your goals, and my job is to help identify strategies that will work for your goals. So a little bit about me. I've been in real estate since 2017. I was born and raised in New York. I went to Clarkson for financial information analysis and portfolio management. My goal at that time was to go to Wall Street. I graduated during the wonderful era of the recession that was caused by the financial industry. Ended up finding my way out to California and got into real estate investment. And it has been just an absolute blessing, and it has been really, really fun. And I'm really excited to share that knowledge with you guys. Recently finished the negotiation mastery program at Harvard. I've done, this year I'll hit my 100th house sale, which is really, really exciting. We'll hit somewhere around 90 million in volume. I've closed real estate in 13 different states. I have a personal goal to close real estate in all 50 by the time I retire. Louisiana and Alaska have been the hardest to nail down at this point. So if anybody's got a friend or family member looking to invest in those areas, please let me know. I personally have over 200 five-star reviews across all the different review platforms. I would invite everybody here, if you're considering working with me, with Marshall Reddick, to read those reviews. I think they're super powerful. And I was recently featured on the Icons Real Estate podcast. On a personal note, this is my family in the bottom left. This is my lady Divya. And these are our dogs, Oliver and Lucy. We just rescued Lucy. She's a 2-year-old Doberman, and she's still learning to acclimate to normal life. So if you guys hear any chaos in the background, that's her. I apologize for that ahead of time. She's a good girl. She's figuring it out. So Marshall Reddick, who are we? What do we do? Right. So first and foremost, we're a real estate broker. In any given year, we will buy, sell, or 1031 exchange approximately 800 properties. About 30% of those are primary residents, so people within our markets who are looking for a home. The other 70 piece of the pie will end up being long-term real estate investing and rental property. We're also a property manager. Today, we manage just over 3,000 rental properties for our clients in the markets that we're located in. And that property management is really the key that allows our service to be so turnkey, right? Our clients are tax professionals, they're teachers, they are firefighters, they are doctors, you name it. And a lot of them, find a need for real estate in their portfolio, especially for the tax advantages. But being a full-time landlord is not that much fun. Ask me how I know, right? And so by providing property management services to our clients in the markets we operate in, it allows our clients to purchase, acquire, and hold long-term rental property and still be able to focus their time and capacity on their families, their careers, things of that nature. We're a private money lender, so we lend out money to real estate professionals when it comes to fix and flips, bridges, IOs, things of that nature. Situations where a conventional loan is not available or doesn't make sense, Marshall Reddick provides a option and a vehicle for those clients. And then lastly, we have a private equity fund. This is a fund in which our clients can pool their money together, and we invest that money in first lien holder position mortgages for our clients. And then kind of going back to what I had mentioned earlier, all these different real estate vehicles, they all behave differently, return differently, and act differently. My job as an advisor here is to understand what it is you're trying to accomplish, and then analyze all these different vehicles to figure out which methodology and which strategy would make sense for you. This is a map of everywhere that we have physical footprint offices. Now, we operate in all 50 states. We have agents and partners in all 50 states. So if you own real estate anywhere in the US, or you're interested in acquiring real estate anywhere in the US, we can help you. But this is where you're going to find our actual physical Marshall Reddick offices. These offices will have buyer's agents, seller's agents, property managers, maintenance managers, tenant coordinators, accounting, so on and so forth. So if you're located in any of these areas, please feel free to stop in. We'd love to meet you. So we like to start this off by talking about how we choose where to invest. You know, during the COVID markets, we saw appreciation everywhere, right? It was just kind of a byproduct of these incredibly low interest rates and low inventory, right? But now that things have started to settle, we're seeing a lot of markets adjust, right? There's many markets in the US that have seen 50% adjustments, and you know, even here in Southern California, we're starting to see price adjustments, right? So it's very important that we invest in the right areas. And these are the criteria that we're looking for, right? This list is in no specific order, right? But we want to be somewhere with a strong job market, right? It's very important that you invest in an area that is growing, right? And also has economic diversity. Use Detroit as an example, right? When the industries, you know, the auto manufacturing industries in Detroit went through their hardships, it took out an entire city, right? And real estate investors got hit really, really hard, right? So we want to be in areas that are diverse economically, many different industries. So as we find industry shifts, we're hedging our risk, right? If that makes sense. We're looking for places with low vacancy rates. There are plenty of markets around the US with really low price point investments, but a lot of vacancy, right? You want to be somewhere where vacancy is low, so there's high competition for your investment property, right? There's two things that kill your return when you're investing in real estate. That's your vacancies, the number of days that your piece of real estate is not actively collecting rents, and then your maintenance costs, right? We're looking for places with housing affordability. You know, the average home price in the US is somewhere in the mid fours right now. Investing in areas that are extremely low priced often comes with challenges, vacancy challenges, you know, tenant tenure challenges, things of that nature. But conversely, on the opposite side of that spectrum, investing in extremely expensive areas comes with challenges as well. Price to rent ratios often are not advantageous. Tax rates are not often advantageous. And though purchasing somewhere to live in we'll call like a premium market, obviously makes a lot of sense. When it comes to building a real estate portfolio, we really want to focus on areas where the housing is affordable, right? It helps keep those vacancy rates low. We're looking for areas that are landlord friendly, right? We are based here in Southern California. Southern California is not landlord friendly, right? But when you look at the other areas that we're focusing on, Texas, Tennessee, Florida, things of that nature, the laws are written in such a way that the landlord holds the power. And that's very important, right? Things in California here, for example, you know, if a tenant decides that they don't want to pay, you know, you have to go through a legal eviction process, which can take up to 18 months. And that's 18 months of you not collecting rent while your mortgage is due, while your taxes are due, things of that nature, right? So investing in landlord-friendly areas is extremely important. We look for areas with strong education, right? A very big reason that people move are due to schools. And we want to make sure that you're in an area that has really good schools, not only does it help keep your vacancy rates low by keeping your competition up for that product, right? But you often find stronger appreciation rates in markets with strong education. And lastly, reliable property management, right? We want to be in an area where there are many property management options to choose from, because it forces those property managers to provide a good service. If you're investing in an area where there's only one property manager in town, there's nothing forcing them to provide great service, right? And there's a saying that you date your realtor, but you marry your property manager. And that's very, very accurate, right? Your realtor is with you for a short amount of time while you identify and acquire your asset, but your property manager is with you day in and day out through the lifetime of that asset. And so having strong property management is very, very important. And so this is how we've ended up in those markets that I've shown you before, right? Just so that to provide some color and some clarity on why we work in the markets where we work. And this is us. This is a picture of our staff from all of our different offices. And something I always like to point out here is that, you know, all of our staff are professional real estate professionals, right? No one in these pictures does real estate as a hobby or as a second job or something to keep them busy during retirement, things of that nature. Everyone here is very educated and very experienced in what we do. And that really helps to provide the kind of experience that our clients have come to expect from us, right? So we like to just, you know, show our faces a little bit, if that makes sense. Okay, and now I'm going to hand it over to Rob. We're going to talk about tax advantages, right? That's what everyone's here for. And Rob, we certainly appreciate your time here. We know it's late in the day and it's dinner time and all that. So thank you so much for being available for our clients. As Rob wraps up, we're going to hop into some Q&A. And then we'll tie it out with a couple more points on Marshall Reddick and how you can get in touch with Rob and I after this seminar so that we can answer any questions you have and help provide the services that you guys came here for. So without any further ado, Rob, thank you so much for being here. We appreciate you. And please take it away, sir.
Great. Thank you, Tyler. Thank you for the great introduction. Thank you, everyone that's attending tonight. I'm very excited for this topic. I get this all this time, being a CPA, a tax CPA. We know that real estate is one of the most powerful wealth building tools out there. And at that same time, tax codes can feel like a maze, you know, with how do I qualify for depreciation, real estate status, right? And maximize that benefit. So whether you are, you know, a seasoned investor in real estate, whether you're a part-time landlord, or you're just looking to close your first deal, I think this presentation will be insightful, and hopefully you'll learn something out of that, out of the presentation today. So a couple points about myself. So my name is Rob Udall. Thank you, Tyler, for the intro again. I've been in this industry for 14 years. Also graduated around the time of the recession. So I graduated Cal State Long Beach back in 2012, got my CPA in 2015. And have been with Murphy for over 15 years. So just recently, I got promoted to partner. So I was a manager for about 6 or 7 years. And my expertise stretches across multiple industries, so real estate, financial sectors, manufacturing, and other professional services. So I do individual business, some trust returns, so the whole gamut. Full insight on our firm. So our firm's Murphy. We had, you know, it's two twins that started the firm, along with their late father, Pat and Mike Murphy, and their late father. So they started Murphy. They're going on 45 years strong as of this year. So it's a team of about 140 full-time professionals during tax season. And this is just our mission statement. So provide the best in professional services to each of our clients with an authentic personal approach. So we're not looking to build a relationship. So Pat and Mike were 2 of 14 kids. So you can imagine being in an Irish Catholic family, so bringing that culture to Murphy, starting their own tax practice. They really are intentional with creating a relationship with ourselves and with our clients, and also coming up with creative ways to save our clients tax dollars. Provide perfect personal and professional advancement to each member of our firm, and maintain an environment of friendship and support. This picture here is just at the most recent Christmas party when me and another partner got promoted. So far as our footprint across the US, so we've got about 7,500 clients, so that's individual and business across the US. I know that the key markets for Marshall Reddick, Texas, Florida, Tennessee, definitely have representation there, clients all over the US. And we focus on individual tax prep, business tax preparation, from incorporating all the way to selling, businesses. I've got exposure with both audits, reviews, compilations, business advisory services. So people that own businesses and are looking for a virtual CFO at a fraction of the cost. Retirement planning, tax planning, and then some of the COVID tax credits that we're still seeing and taking advantage of for our client base. So some topics to cover today. So what we're going to go through is how to qualify as a real estate professional. So we'll kind of go step by step. Testing for what's called material participation. How to avoid passive activity limits. So I'll kind of explain when you first get into real estate investing, typically it's going to be passive activity, so we'll go through that. How to realize full deduction of rental losses. Key considerations for real estate professionals. Avoiding what's called the net investment income tax. So there's a 3.8% tax surtax, so we'll see what you can do to avoid that. Depreciation deduction. So we know with the Tax Cuts and Jobs Act that's set to expire, pretty soon here, unless the current administration extends it. There is some opportunity from 2025 to 2026 to take advantage of depreciation. And so some of my clients are holding on, waiting to see what Congress comes up with in the next couple months, especially people with real estate, because depreciation usually is an opportunity that I explore with taking advantage, depending on what tax bracket they're in a given year. All right, disclaimer. So just like to put that in there in this presentation. We're going to send it all to the attendees today. So qualifying as a real estate professional. So there's really two tests. Okay, so the first one, we have to have at least or more than 50% of all services, personal services performed must be in real property trades or businesses. And we'll go through that in the next slide of what do I mean by real property trades or businesses. Next one is a 750-hour rule. So on an annual basis, you have to keep track and spend at least 750 hours annually on real property trades or business. If you hit those two tests, then you can qualify as a real estate professional. First thing I'm going to kind of zone in on is this one here. This typically, for clients of mine that have a W-2 job that's not related to real property trades or businesses, this is usually the first disqualifier. But there are some creative ways that we can, see if they can qualify. But typically, if you've got a W-2 job, typically that will disqualify you that if it's not in real property trades or businesses. All right, so again, examples of this would be acquisition, construction, development and redevelopment, rental, operation, conversion, leasing, property management, also real estate brokerage, including real estate agents would qualify for the 750 hours. One caveat to that would be mortgage broker of financial instruments, so they actually do not qualify. So employee hours, as I mentioned in the last screen before, so if you have a W-2 job that is, qualified under real property trades or businesses, you can count those hours to your 750 hours as long as you're at least a 5% owner in the business. The IRS, and there's an IRS code there that says, hey, if you are a W-2 employee, but you do own 5% of the business, you can use those hours to qualify for real estate professional. So kind of interesting there. At the end, I'll go through some strategy that I've done with some of my actual clients to qualify for real estate professional. Furthermore, they have to meet both tests, so the more than 50% of their time on real property trades or businesses, and then the 750 hours. When they do that, you have to go one step further. So we have to evaluate if what the IRS calls you materially participate in each rental real estate activity to determine if it's considered passive, where losses are limited or suspended and carry forward for future years, or non-passive, where you get the full deduction and where that can offset other buckets of income, W-2 income, investment income, okay? So that's initially just, at a high level, how do you qualify for a real estate professional? So material participation, we're going to jump into this. So I want to save time for questions. So material participation, there's really 7 tests, and I go through this with my client base. So, I do tax planning with my clients throughout the year. If they're thinking of, investing in properties and they want to qualify, we'll have these types of conversations throughout the year. So we're planning as they go and invest. So there's really 7 tests. I'm only going to highlight a couple that I think pertain to real estate. The first one being the 500-hour. So think of this as an activity by activity. So one rental property, or if you have property held in a partnership or an LLC, this is what you have to test by activity. So 500 hours, the taxpayer participates in the activity for more than 500 hours in the year, that would qualify. You only have to hit one of the 7. If you're the only person that does it, so say that you're the only person that's really managing it, and it's higher than any other person that has involvement in it. So 100 hours, and that is higher than anyone else, you would qualify under majority participation. Substantially all. So this one's kind of tricky. So taxpayers' participation constitutes substantially all of the participation in such activity of all individuals, including non-owners. Sounds kind of tough. So if you have gardeners, they would actually qualify as a non-owner who participates with managing the property. This is kind of rare. I don't really see this. Usually it's number 1 or 2 that I see qualify. So I'm not going to spend too much time there. Significant participation doesn't apply to rental activities. Prior years. So say you actually hit material participation 5 out of the last 10 years. So say you hit 500 hours for 5 of the last 10 years for one of your properties. You're automatically qualified under this number 5, prior years participation. Personal service activity does not apply to real estate activities. And the IRS likes to put kind of a blanket facts and circumstances. So if you can, and there's court cases backed by this, if you can prove for all intents and purposes that you are establishing material participation, you would qualify. But typically, in my experience, you see number 1 or number 2, 500-hour participation. Moving on. So again, I mentioned each rental property is treated as a separate activity. Each one of them have to be tested. So in this kind of illustration, we're using the 500-hour test. Say you have one property that you spend 600 hours annually managing the property, right? But you have another one that's under the 500 hours. It's 160 hours. So for this reason, this one would qualify. So you'd be considered, if you're a real estate professional and you materially participate in this activity here, you get full deduction on the losses. So, if you have accelerated depreciation on this property, say you just buy it and you're looking to acquire this property, all that time and energy goes into this, and you came up with 600 hours, and you do a cost segregation study on it, and there's a $70,000 loss, that would be considered non-passive. That can be offset. You can use that loss to offset other buckets of income. On the other hand, say that this property, again, under 500 hours, you don't materially participate, so it would be considered passive. And those losses would be limited or suspended until future use. So it kind of goes in a separate bucket, and it's considered passive losses, which would continue to move forward. And the way to utilize those losses that are carrying forward, is to offset it against other passive income. So say you have another property that's passive, that is generating income. You've had that for a couple of years, it's passive income. You don't really hit the 500 hours, self-managed. You could use this loss to offset that. That's typically what happens. Or if you accumulate all these losses, once you sell the property and you dispose of it, it frees up all of the unallowed passive losses. So again, a planning opportunity for my client base. I like to have conversations with them if they're looking to sell a rental property, hopefully they're not, or 1031 exchange, but this is a factor in that. One interesting thing that the IRS allows is you can actually group your activities in one just one group. So there's an election you would make where you would permit all taxpayers to treat all your interest in real estate as one activity. So it's easier to meet because of that. You know, you just saw the 7-factor test. It's sometimes hard to meet it. So if you can group them all together, it's easier to meet this test and free up those tax losses. So you just make a simple tax return election. I've done this with a lot of my clients. It's binding in the tax year that you make it. So even though you don't file your taxes till the following year, for example, we're filing 2024 tax returns. Once you have your tax appointment, you know, you can make that election when you're filing it this year for prior year taxes. And it's permanent for all future years unless you revoke that election. So again, with this example, it should be pretty simple to illustrate this. So say now we make this election on the IRC code listed there. Now it all gets grouped together. So instead of only qualifying for one of the activities, now you combine all the hours, and that's 760 hours. So with that, both would qualify, okay? So I just want to summarize this in a helpful flow chart. So this is kind of the example I go through with my clients, some of the questions I ask to say, hey, just bought a rental real estate property, or I've got a couple and I've got some investments. You know, my spouse is active in it. Do you think we qualify as a couple? If my spouse qualified for real estate professional, those are types of conversations that come up. And here's the flow chart at a glance, and then I'll just walk through step by step. And this is basically what we just went through in the previous slides. So again, the number one thing is, did you spend 750 hours in real property trades or businesses? So let's just say yes, right? Now, again, this is a harder test, the more difficult test to meet. Are more than 50% of your services in real property? So if you're able to prove that, then you would make an election. You can or cannot, or you don't have to. You can make an election to aggregate all your real estate holdings as a single activity. If you do that, then you have to just test out of those 7 tests, did you hit it in the group in total? If that's yes, then you would have to make sure that we have adequate records of the hours. And then from there, you qualify for non-passive as a real estate professional. And that would be losses deductible on your current year and future years. Okay. Kind of going through this, so there you can kind of walk through this. Another way you can qualify is under the green here. So if you materially participate for just one single activity, you don't have to group them. You could still have that activity, you know, freed up as far as losses. So if you really spend a lot of time, that could be commercial property that you're managing. You hold some single family residences. I have a couple clients that do that. They've got both in their portfolio, so they spend more time on the commercial property. So we do show that as non-passive. Okay, so different scenarios that we kind of come across with our clients. All right, now I want to highlight some key considerations. It's not always a slam dunk of, you know, yes, I qualify. What are some things that maybe I'm not considering, right? Well, first of all, in order to qualify, we do recommend you keep highly, you know, detailed records. So logs of time spent per property or per investment if you're searching for an acquisition of a property or dealing with a real estate agent. We ask that they keep track of those records. One thing to consider with most of us, I think the audience here is probably maybe a little over the US, but for California, they do not conform. So that's an interesting difference from federal and for state if you're a California resident. They don't really recognize real estate professionals, so all of that would be passive. I mentioned this at the top of the presentation. So there's a 3.8 surtax on investment income. So if you have your mutual funds or investment interests and dividends coming through, and you also have real estate, any income that's generating from that typically is considered net investment income, and it's subject to a 3.8% surtax on that. That starts to kick in at 250,000 if you're filing a joint return, single or head of household 200, and if you file separate, 125. Interesting thing is for real estate professionals, you're exempt on this. So that'd be an annual thing that you could be saving on if you're generating rental income, because that's really your trade or business, and it's not considered investment income. It's really your trade or business. So right off the top, that'll save you 3.8% on that, okay, if you're above those thresholds. Where you really feel the savings, it's significant when a property is sold. So say you sell a property for, and the gain is $1 million, just to keep things simple. You got 3.8 of that you would ordinarily pay the surtax on, right? So if you don't have that, if you do qualify, you would save 3.8% on the investment property that you sell because you're a real estate professional. Depreciation. So as you all know, there are accelerated depreciation methods. This is set to go down under current tax law. So for 2024, for federal purposes, you get under 20-year property, you can depreciate up to 60% in the current year for 2024 tax returns. It's set to go down to 40% and then be completely phased out by 2026 when the Tax Cuts and Jobs Act is set to sunset. So interesting enough, if you do qualify for real estate professionals, you can realize increased deductions in early years of ownership. Okay, and where I mentioned it's really multi-year planning, because if you're in a low tax bracket now, and you're going to ramp up your activity, you're going to ramp up your income in the future year, we may want to defer some of that to future years. So when I say it's not always a slam dunk of yes, let's qualify for a real estate professional, it really depends. I've had a client that has received a bonus from their spouse's W-2, and that now put them up in the 37% tax bracket. Well, I may just hold off on some of this depreciation on real estate professional status to align with that anticipated increase in income. But depreciation, typically you get that increased deductions in early years. So there are tax planning opportunities there. Another interesting thing that we could do with rental properties, and we evaluate all the time if we think it's a good exercise to go through, is what's called a cost segregation study. If you buy a piece of commercial property, it's usually over 39 years, unless you do a cost segregation study, and they really segment and pick out different pieces of the building. If it's an HVAC system, if it's exterior, if it's carpeting, so they break that all out so that you can take advantage of depreciation, bonus depreciation. And unless you don't qualify, unless you're not a real estate professional and you don't have material participation, usually those losses just get carried forward. So again, it provides us with opportunities to save our clients tax dollars. Okay, so I think I went through, I wanted to allow for time for questions here. Went through how to qualify, testing for material participation, how to avoid those passive activity limits, how to realize full deduction of rental losses, some key considerations, the net investment income tax, and then depreciation. So before I open it up to questions, I think Tyler's going to jump in here. Here's two other managers that we did a presentation on the same topic, I think back in August, and they both were on here. So just wanted to provide their contact information and then of course my information here as well. So hopefully you've either filed your taxes or filed an extension. We're always available for a free consultation if you're looking to get a second opinion on your taxes. If you're not sure if you're getting the most out of your tax return, feel free to reach out to us. Great. So I might hand it back to Tyler. Yeah.
Thank you, Rob. We appreciate you so much. Yeah, we had a couple questions here. I'm gonna bring up a few, and then
Sure.
just so we're being cognizant of everyone's time, if I don't get to your question today, I'll make sure that we get an answer for you from Rob. So here's a question from Chris. Chris wants to know when we're looking at having to hit a minimum number of hours in order to be considered a professional, right?
Yep.
Are there any industry standard or any best practices when it comes to keeping record of those hours, or is it something that we can just say that we've spent that amount of time on?
So I typically have a log. So if they're acquiring, depends on how involved they are with managing the property, talking with the property management company. I try to break it down on a monthly basis. Some of my clients have no idea. So I kind of talk it out through them. But if they have an Excel sheet or something pretty simple, if they on average spend 5 to 10 hours. So 750 hours divided by 12 months, it's about 62 hours a month. So I kind of start at a top level and dive down, Chris. So if you have, just a ballpark number in your head of this is how much I think I spend, I kind of go from there and then drill down. But if we're planning for the future year, I ask if they can, put a simple log together, an Excel sheet, doesn't have to be anything fancy, of managing the properties, if it's acquiring, if it's talking with the maintenance people on the property, potential renters, things of that nature. Yeah. Hopefully that answers Chris's question.
Perfect. Thank you, Rob.
Yeah.
And here's we'll get one last one here. Sarah has a question. Sarah has recently retired from a W-2 job. And so being that she is now entering retirement and is taking retirement from her W-2, does her pension or her retirement affect her ability to qualify as a real estate professional now that the W-2 is not like a full-time job?
Oh, great. That's a great question. Yeah, if you're retired, that time now it wouldn't be, so you're not really actively working in that because it's retirement income. So that would not compromise your ability to qualify for the 750 hours. So you would exclude that, exclude any time, you would exclude that income. There'd be really no time because that's just income you're getting from retirement. So yeah, I think you could qualify. Yeah, if you're spending
Perfect.
time, yeah, just for
Perfect, Rob. And I think what I'm getting from this and what I'm hearing is that all of these scenarios are so very personal,
right.
And the best way to really understand your possible advantages is to have a one-on-one conversation because there's so many different moving factors.
It really is, and where there's stage in career, stage in life, what are their investing goals for the next 5-10 years? 100%. Yeah.
Got it. Excellent, excellent. And for everyone else, I'll make sure that we get your questions answered from Rob here. As we're tying out the hour, I want to make sure that we're being cognizant of your time. A couple things that we want to make sure that everyone here tonight knows is available to them, right? So the first is our Marshall Reddick Property Rating ebook. For those of you who haven't invested in real estate yet, or even, sometimes I'll run into people who have been investing but aren't familiar with property rating, this is a really great place to start. Basically, there is what's called an MSA, right? It's a Metropolitan Statistical Average for every major city in the US. And after crunching the data for so very long, right? And we wrote this book. This isn't something we copy and pasted. This is ours, and it's absolutely free. It's an easy read. It's about 42 pages. Great place to start. We dive into the idea and the strategy and the analyzation of comparing investment property to the MSAs in the area, and we have found extremely correlating data showing how these investments will return and what the landlord experience is like based on the price points that you're purchasing in those specific MSAs. And so this is a great first read if you're thinking, hey, maybe having real estate in my portfolio is for me. Great place to start. So we just want to make sure you guys know that this is available. If anyone wants a copy, please let me know and I'll send one over to your email. We also have data packets on all of our markets. And so every single year, we go in and we crunch all the data from that market, right? We're going to be looking at appreciation rates. We're going to be looking at, number of new homes constructed. We're going to be looking at price to rent ratios, all that kind of stuff, how inventory has reacted to interest rate movements. And it's all very different for all markets, right? So as you are analyzing different markets that are of interest to you, please know that we have these available for all the markets that we are involved with. So if anyone is interested in possibly Texas or Kentucky or Florida or anything of that nature, you thought that might be an interesting market to invest in, let us know and we'll get these data packets over to you. They're, extremely, extremely easy to understand, but there's a lot of data in there. So if you're of that mindset, of that personality that you like to crunch numbers, this is a really good piece of data for you guys. So just want to make sure that that's available. We'd invite everyone here to check out all of our reviews, right? Naturally, we're going to, talk about how great our service is, because that's what we truly believe. And we work really hard to provide a great service for our clients who are looking to invest in real estate. But it certainly hits a little different hearing it from people who are our clients. We want to make sure that you guys know that these are all available for you, and we would invite you to check those out. We'd invite you to follow us on social as well, right? You'll find us on Facebook, on Yelp and LinkedIn, Instagram, all of that. And if anyone here feels like they learned something tonight, like tonight was valuable for you, we'd certainly appreciate if you'd be willing to leave us a review, so that other people in your shoes, as they are dipping their toes into real estate investing and are starting to go down that path, that they have the opportunity to hear your thoughts and what your experience was like learning with us today. So if anyone is interested and willing, we'd certainly appreciate your willingness to leave us a review. And ultimately, if anyone is interested in learning more, I would invite you to have a free consultation with me. And this is what that consultation look like. I would, ask you to budget about an hour, right? And we're going to sit down and go over your goal setting. Everybody has a different goal when it comes to investing. Some people are planning for their children's college, right? Some people are planning for retirement or early retirements. I had a client not long ago who decided that he wanted to get a Ferrari by the time he was 40, right? And so we want to sit down and evaluate what it is you're trying to accomplish, so that we can then evaluate your options. Like I had mentioned before, we have many different modalities and vehicles here in which you can invest in real estate. They all have different types of returns at different velocities and different time frames, right? So we want to evaluate your options and then decide on your time frame. Are you looking for something long-term? Maybe you just retired and you're looking to offset the loss of your W-2 income, and so we're looking for cash flows today, right? So we want to understand your time frames, and then we'll sit down and look at the criteria, right? Is a single family home right for you? Perhaps multifamily is more in line with your goals, right? Perhaps mortgage investing is going to provide you the velocity of return that you need in order to accomplish your goals, right? So we're going to sit down, go over all of that, and then I'll help you identify markets where that's possible, right? Texas acts different than Tennessee. Tennessee acts different from Florida, right? There's different velocities, like I mentioned, different tax rates, all this kind of stuff. And so I'll help you identify places and modalities that could help you accomplish your goals. And then ultimately, it's my job, think of me as like the Marshall Reddick quarterback, right, is to introduce you to the key players within the organization who can help you accomplish those things, right? If we decide that, maybe a new construction duplex in Central Texas is going to be the modality that's going to help you accomplish whatever your goal may be, I'll get you introduced to that team, right? If we decide that maybe private equity and our Marshall Reddick Mortgage Fund, it makes more sense for you, you're looking for something maybe a little bit more liquid, whatever might be what it is you're looking to accomplish, I'll make sure that I get you in touch with those people, right? So this is what a conversation looks like with me. And this is where the majority of our clients have started with Marshall Reddick. They come to an event, they sit down, they have a conversation with me, and then I help put them together with a team here at Marshall Reddick that helps them accomplish what they're doing, right? And I saw some familiar names on the registrant list this evening. Some of you have been with us for a very, very long time, and we certainly appreciate your business and your trust. And for those of you who are new with Marshall Reddick here this evening, and it's so nice to meet you. And I certainly hope that we get an opportunity to have a one-on-one conversation. Again, guys, this is me. This is my contact information. Please feel free to call me, text me, email me. You can FaceTime me if you'd like, whatever works for you guys. I look forward to having the opportunity to assist all of you tonight with your investment goals. Again, would invite all of you to check out my personal reviews online as well as the organizations. Rob, thank you so much for being here tonight. We really appreciate you. I certainly learned some things tonight too, and I've been doing this for a long time. So your value has not gone unnoticed. We appreciate you, and I'm sure that many of our clients here this evening would love to have a conversation with you moving forward. So everyone, again, thank you so much for being here. I hope you have a wonderful night, and I look forward to speaking with everybody. Also, we're going to shoot a copy of this recording of this seminar to everybody, so keep eyes out for that in your email. If for one reason or another it doesn't pop up and it's not in your junk folder, just shoot me a message and I'll make sure to get you over a copy. Have a great night, everybody. We appreciate you. Rob, thank you again, and we'll talk to all of you soon.
Appreciate it. Thank you.
Bye, everybody.
Bye.